Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Hopefully you guys had a good Thanksgiving. Just wanted to throw that out there. Today we're going to be talking about a bunch of different metals, the deficits, and my financial opinions around the situation that we're in. We're also going to talk about declining ore grades, the energy it is to get out, and kind of the inventories that we're seeing and the discoveries that we're seeing in some of these metals. So we're going to be looking at copper, zinc, whatever else I have in here. I can't remember all of it. And energy as well, the cost curves of energy. So let's dive in. Let's take a look and see what's going on in here. And if you guys need any help in this commodity bull market, definitely sign up for the finding-value.com, the platinum memberships, the membership I would choose because we go over daily update, or we go over individual companies. If you're a platinum member, and we have the weekly platinum question and answer session that's coming Saturday at 7 a.m. Mountain Standard Time. So looking at this, what we've got here, I'm going back to the good old PowerPoint. It says, red hot, the price of copper has defied signs of a global economic slowdown, trading not far from its recent all-time high of 10,845 per metric ton. So, you can draw a trend line through here. It's a long-term trend. We are still in an uptrend. We had this big pullback, and if everyone is saying that this monster recession is going to come, we should see it in the price of copper. Thing is, we haven't seen that monster recession in the price of copper yet. I mean, this could be the pullback that we get, and we start ripping higher again. Now, I don't want to be too quick to say that it can't fall down. I'm not saying that. But this was the last pullback here in 2008, 2009, and then it ripped again all the way to the high in 2011. To me, it looks like we have a similar pattern. We get this lead-in pattern from 99 all the way down to 2001. That's this lead-in pattern here. And it was over-exaggerated to the downside with the medical event in 2020. We ripped on higher. We ripped on higher. We've got this three-top hump. This is kind of that three-top hump, and then it came on back. And I think we're basically bottoming out before a move higher. That's kind of my best guess. It is anyone's guess at this point when you're trying to look at these things. And again, guys, I'm not in the predictions game. I'm just in the statistical probabilities game, where if we're cheap and the market conditions are ripe for this to go higher, that's where I put my money. It's all based off of where the tailwinds are. And the tailwinds, if we were to look at the supply deficit, this is the long-term supply gap remains unsolved with widening midterm deficits. This is the most recent that I've seen. This is the source, Goldman Sachs Global Investment Research. This is copper. Global copper production is the dark blue line. The light blue line is global copper consumption. And what I'm looking at is this gap out there. The gap becomes pretty pronounced somewhere in the 2024 range or era, where it basically moves apart. Another thing that we can look at is the inventories of copper. And we've seen a dramatic decline in copper inventories over time. It is very low. So this gap, what it's going to do is it's going to eat through all the inventory and then rocket the price of copper up. So that's what we're seeing out ahead of us. This is what you should remember when you're investing in diversified mining companies and copper companies. You should know this gap right here. Now, here's major copper discoveries. This here needs to be, if we're going to do this gigantic renewable electric world in the future, we have to find something to fill this gap. Problem is, we have a major copper discovery drought. There's nothing to fill it. This is where there could be a major opportunity if you're an investor in copper, especially in existing copper mines which are producing, because they're going to realize, I think, much higher copper prices when they sell them out in the future. I don't see too much projects that can fill that type of gap. And when I see what potentially could be coming in declining ore grades for these new projects, it looks pretty bad from an energy standpoint. And we're going to go over what exactly is happening in copper here. So we've got the average copper ore head grades. This is your grade, and it was basically almost 1% in the early 2000s, and we've been declining down to 0.53% in 2025. Now that's the average. All of these that are coming on over here are really low ore grades. They are generally below 0.53. So when we look at these next graphs of how much energy it takes to extract ore grades that are below 0.53%, that's what's coming on that's new. So in order to fulfill this gap, or fill this gap, I should say, we're bringing on some pretty bad ore grades. They're very low. And if the average is 0.53% in 2025, that's going to be a pretty low ore grade. So when we look at this, we kind of look at this upper left. This is the cumulative energy demand. As your ore grade goes down, which is going to the left, you come back. This is your exhaustion and increasing supply, and you start to hockey stick at some point. Technology is trying to push this curve down where you could mine lower ore grades with less energy demand. Economies of scale try pushing it down, and mechanization brings that up as you try to extract it more per unit of bucket loads or whatever. So when we look at this, you can kind of see the progress in time. 1930, we dropped down in 1970. We've got declining ore grades, but we've got technological improvements, economies of scale. That's all getting put in there, but we still have this exhaustion. In 2010, we are basically using more energy per ton of copper in 2010 than what we used in 1970. So the technology over that 40 years did not decrease your energy intensity per ton of copper. Now that we're going below 0.5, you can see that we're hockey sticking up in terms of the cumulative energy demand per ton of copper as those lower and lower ore grades come online. So when I look at the projects coming out there with lower and lower ore grades, I don't necessarily see that as a positive for the copper, the copper area. I mean, it might be for an existing copper producer that has higher ore grades. But when you look at the new guys, I don't think they're going to make that much money. I think their margins are going to be pretty lean and pretty tight, or copper is just going to explode higher, which could be the case. But everyone who wants to extract copper is going to use copious amounts of energy. So that copious amounts of energy, I think, is positive for energy. So in order to make the renewable world future work, you're going to have to extract copious amounts of fossil fuels in order to make that work, I think. So I'm a big bull in oil and natural gas because of all of these declining ore grades and the increasing energy intensity to get a ton of whatever you want to get out of the ground. It could be a ton of gold, it could be a ton of copper, it could be a ton of zinc. It doesn't really matter what it is. So when we start looking at this is real world data. And we've got the energy intensity here. We've got our grades on the bottom. And this is for surface mines. This is for underground mines, all mines electricity, all mines diesel only. So if you look at all energy, you can see as your grade declines, your energy use goes up dramatically. It is up threefold from here to here, over a threefold increase. Same with your underground mines. As you go down in ore grades, they really start to hockey stick. And you can see that that's also probably a 5 or 6 times energy intensity or more. If this is 0.1 or point something, I don't know exactly, but if it's 0.1, that's 7.5 times more, 8 times more, 9 times more as you get up here. Diesel, obviously the same thing as your ore grades decline. Does look like there's some sort of, I should say, some luck or some good fortune here if we've got this cluster down here. Maybe they're doing something with good technology or something. And then electricity also shows that it goes on up some. When looking at the energy consumption, and this is copper ore grades, you can see what it looks like as we go down in ore grades for a variety of different metals. Copper's in the green here. What we have is energy consumption versus copper ore grade. This is on the bottom here is log scale. And what you typically do is you try to fit an equation to it. What this is an exponential function where it kind of hockey sticks higher here. So they usually have an exponent of some factor there. This one's more of a linear graph on a logarithmic type chart, log scale, which is a function of the scale is the function of the exponential function. So as you can see this hockey sticks to the left as you go down in ore grades. You can see that there's a relationship from lower right to upper left, which means you consume more energy as the ore grade declines. And it's across the scale for copper, zinc, and even gold. So what I think is going on in the future, what you're seeing is a lot of the new companies are finding basically dust in the ground. And for us to extract all of this in ever greater quantities, you are going to need an exponential amount of energy. And that's where your opportunity is, in my opinion, as resources decline. I want to also make this comment here. All of the wealth in the world, if you think about it, is more or less a derivative of energy, and it's more or less our ability to manipulate the world around us and to extract commodities and make them into usable products. It is that simple. This here is what's blocking us, potentially blocking us, from extracting ever greater quantities of minerals out of the ground, is the declining ore grades. Now, I'm going to look at our global liquids capacity in 2030 by breakdown. This is our oil global liquids here. This is our break-even US dollar per barrel of Brent, and this is our capacity in 2030. So as we go up, you can see that we have the high-cost producers on the right, and then our lower-cost producers as you go to the left. But here's the thing. In 2030, I think that we're going to see substantial declines in some of these outputs, in some of these areas over here, like Saudi Arabia even. If that were to happen, this whole curve is going to shift to the left, and our production will go down. The pricing at $100 are some of these frontier oil shale type movements, other tight oil around the world. But our returns from that oil are far less. So even though people think in terms of volumes, what you need to think of is how much energy can come back to produce work in society. And with declining energy returns of all these on the upper right over here, the far right, your returns of energy to society decline. So the price matters less, and the energy that's in the system to do work matters more. If we go into producing all of these lower grade or grade minerals, we are going to have to get probably solutions that are different from oil or diesel or electricity-driven fossil fuels. We're going to have some sort of other way of doing it, and I don't know how you can do that without extracting a whole bunch of different minerals. That's where the thing gets into like a catch-22. It's like, we need something to offset oil. Well, first we need to drastically increase our use of oil to do that. And you're like, how do you do that if you're in a problem of oil? So my favorite plays are obviously direct investment in fossil fuels that can grow production. And I like some of these high-cost producers because, one, they're small, two, they can grow production, and three, they're high-cost producers, which usually provide a lot of leverage to the price of oil. So I like all three of those things. Now, looking at some of these other metals, we've got a silver supply crunch. They're in the same situation in terms of declining ore grades. Declining ore grades will lead to higher cost curves, which will lead to more expensive extraction. Now, another thing, if we start getting short on this type of energy, and energy increases a lot in dollars, in how much it costs, you're just increasing all of the metals to extract. Their cost curves will all go up. But the silver supply crunch is here. You can see our inventories are just drawing down. We're at 40 million ounces in 2022 here. It may even be lower than that. We'll see. But that's the COMEX depository warehouse. We've got gold mine decline. I just grabbed this. This is gold production in Australia is forecast to top out in 2021 as mines shutter, Minex says. Exploration discoveries, new projects and existing mines. You can see it go out in the future and the decline, at least in Australia, of gold. So I thought that was a cool chart. Another one from Barrick says gold supply forecast industry decline. I think this might be gold supply by region. This is the entire world with everything stacked up. And you could see a peak in 2020 or 2021. And this is basically where it peaks. And then we start heading lower for the world. This is what happened during other bull markets of gold. We had a decline in production. And then there was another investment cycle, and that cycle got larger and larger. But here is the weird thing about this cycle. All of those other cycles had copious amounts of energy to grow into. I am not sure if we've got a copious amount of energy to grow into out here in 2029 or whatever, especially with declining ore grades, which require exponential more energy in a world that may be very short on energy. So the way that I view this, and maybe I have the wrong viewpoint, is metals will become more valuable in the future because their cost curves will go up because of declining ore grades and more expensive energy and less energy that is returned to the world that can be used. So energy is going to get, I think, a premium, at least those that are from fossil fuels. And I don't see how we can sidestep the fossil fuel increase and just work our way to something else yet. Maybe that's my limitations of how I look at this. Total global platinum supply from 2005 to 2022. What do you see here? You see a decline in production of platinum. It's already peaked. It peaked in 2006. We had a furious move in 2011, but I'm not sure if we're ever going to eclipse that or not, but it is declining. We've got platinum historical stock of eligible and registered. We can see that the inventories from April 2022, and we are just eating through them as they decline and decline. Right now, we have 143,719 ounces in our inventory. Here's zinc and aluminum LME inventory. That is also from an upper left to lower right. That was above 1.2 million tons for zinc inventory. Aluminum inventory was about 5 million in 2012. And we've been eating through it. We had a little bounce in 2020 with the shutdown, and now we're eating back through it. So we have the world running into constraints producing aluminum and zinc, or at least maybe underinvested in it, and we're at very low inventory levels. Now, if you look at the new era, Trafigura says a decade-long aluminum glut will soon be wiped out. Here's the glut. That's the cumulative surplus. And this is the annual aluminum surplus deficit, which is the annuals here. If you look out forward, the annual aluminum surplus deficit goes negative here in 2022, 2023, and we really start to draw down. The cumulative surplus deficit goes negative in 2024, 25. That's where we swap over, and then we go really negative out there in the future. So this is for aluminum. And they said that this deficit is probably not going to be solvable with the momentum that that's going on behind it. This is global silver demand. So this is the demand side for silver. It says the Silver Institute predicts a 16% increase in demand this year to 1.21 billion ounces. There's 2022 demand. It looks higher than anything in the past. You can see we've been ripping it from 2020, 21, and 22. So that's looking pretty good from a demand perspective. This is the last slide I have. This is metals in a net zero scenario. Current production rates of some important metals, including copper, are likely to be inadequate to satisfy future demand. So these are the greater supply shortages. Graphite, cobalt, vanadium, nickel, lithium, copper, PGM metals, rare earth elements, molybdenum, silicon, silver, zinc, chromium, manganese, and lead. All of these have shortages, especially on the right-hand side there. So that's what I've got for today, guys. I wanted to kind of go over all that for everybody and give you the big picture look of what's going on with deficits, with inventories, and a couple of different base metals and precious metals, and the supply and production and the cost curves of oil. This is all important information to understand. So what does the future look like, to you after, basically listening to all this? To me, I think that there's a commodity boom coming. It seems obvious to me. Now the question is, do we have the energy to make this all work? I don't know. That's what I don't know, but I'm going to bet on energy. Because when I see future deficits, I think future energy demand. When I see lower and lower ore grades, I think future energy demand. It's more energy to make this all work. So that's kind of where my thoughts are at, guys. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't subscribed already. And we'll see everybody at 7 a.m. Saturday, Mountain Standard Time, for the question and answer session for the Platinum members. All right, guys, we'll catch you next time. This is Finding Value.